Okay, my friends, we are back now with module 3 of our 12 modules. This module deals with 4 questions every trader should be able to answer. Would add to that 4 questions that you need to answer before putting on a position. And as a reminder before we get started, again, trading involves risk, often due to the compressed time cycle. Other businesses have risk, entrepreneurism has risk. It just doesn't come at the speed at which trading and investing can come. So it's something to be aware of. And if you have an edge at one point, it doesn't mean that it'll last forever. So you have to keep being mindful of that, or it could be damaging to your account. The objective of this module is to be able to answer the 4 questions that you need to answer before putting on a position. And this is going to be a significant game changer for if you've been in markets for some time and have been struggling to get consistent performance. This is absolutely going to help. If you are just getting started, you're going to start ahead of 80% of people who are out there trying to do this, if you can hold to the discipline of what we're going to cover in this module. But before we do that, we want to look at the homework from the last module. Remember, we're going to compile a watch list of popular products. You can pick whatever you want. If you want to use the most active stocks, if you want to use index futures, if you want to use Forex pairs, you can pick whatever those were. You're going to watch or review how price moves, knowing that price moves differently for different products and in different times, as we talked about in module 1, different time frames. Some of them trade in a 24/6 and others trade just 5 times a week. You're going to print out charts. So, print out a chart and mark it up based on the 4 behaviors and the 2 setups that we covered. And then you're going to try to repeat this for multiple time frames. Do it on a 1-day chart. 1 day, 9 months of 1-day charts, or 20 days of 2 hours, or 10 days of 30 minutes, or 10 days of 5-minute charts, whatever that is, and mark these up. This is what we talk about when we talk about deliberate practice. Deliberately going through an exercise and building skill and building an identity or identification of these behaviors and seeing these setups. You will find that the behaviors are consistent. Every mark of the chart you should be able to go from one aspect to the next, to the next, to the next, to the next, and know that you're moving in that direction. And for example, let's just pull up a chart. So we've got an Apple chart here. This is actually a 1 hour. Let's go to a 5-minute. We'll just zoom out here and get several days of data. All that's represented on this chart is just these candlesticks. And then we have volume for each 5-minute period. So you can see at the beginning of the day is always the largest amount of volume. This will be key in the next module when we talk about something called an initial balance. But if you'll notice, we bring up our pen tool here, just as an example. Okay, here is a move, and then a little bit of rest, and then another move, and then a little bit of rest, and then a move. And there actually was an area of rest in here, and then a move that doesn't continue. This is like a test. So it's testing backwards, can't go that way, comes back to an area where it was, and really then trades sideways. Now a move lower, tries to test higher, can't, sideways. So you can mark up an entire chart this way. And they're not like textbook examples. There are structural similarities is the thing that you're going to look for. But they are very effective. And then in terms of the setups that we were looking for, so one of them was a price continuation. So here we have a move higher, and then the first pullback of that move is an opportunity to get into that position, which then that would have been a win there. And today what we're going to talk about is, well, how do I know to get out of this? Or how do I know what I'm shooting for in that type of trade and such? But that's the goal, is to go through and to mark your charts up, looking for those 4 behaviors and looking for setups based on the price continuation or price reversal. Okay. Here's the concept, is that in active trading and investing, decisions made in the moment are almost always emotional and often wrong. Especially if, I've seen this often for traders who want to be, like active throughout the session, in the middle of the day, taking intraday trades. Intraday trade being that you're taking it, between while the session's going on. You're going to get in and get out. I often take those myself, but there are decisions that can be made that are premeditated, and there are decisions that are made off the fly. The ones that are emotional and in the moment are the ones that are going to give you the most headache. So to counter that, we have 4 questions that we approach every trading opportunity with. And here are the 4 questions. And this is going to be your homework as well as you look for something. It's, what is the opportunity? In other words, what do I think that this thing's going to give me if I get into it? Do I know? I will tell you that when I first started trading, I would put trades on. This is to my chagrin that I share this, but I would put trades on and I did not have a price target exit. So I was just putting it on, and I had no expectation of what that would be. And in fact, pure technicians, technical traders don't have an idea either. So if you follow technical traders, they will say, hey, it triggered. I don't know what the target is. Often they really don't. What is the opportunity? This is key. I mean, if you're going to invest in a business, if you're going to put capital in, what are you expecting to receive for that? And to that end, what are you willing to risk to go after that opportunity? Are you willing to risk $10 to make 1? Are you willing to risk $5 to make $5? Are you willing to risk $100 to make $1,000? What is that ratio? And given that you cannot have a perfect system, and that especially initially starting traders, to start at the beginning, if you can do 50-50, if you can be 50% right on your trades, that means just to break even and not see a drawdown on your account, you're going to have a win to loss ratio that's twice. You're going to have 2 to 1, or else you're going to see drawdown. Okay? What am I willing to risk to go after the opportunity? How will I know that I'm right? So what will tell me that I'm right, and what will tell me that I'm wrong? Before I put on a position, I know the answers to every single one of these questions, or I don't put on the trade. I know that otherwise it's just an emotional response, and I'm likely in trouble. Okay, so what is the opportunity? Well, this can be defined a lot of different ways. It could be based on past observations of where the market has been. There's some reference point. It could be pattern-based. If they're technicians will look at this. It could be a fundamental and time frame based. Someone could say, hey, the fundamentals of crude oil says it should be $60 a barrel, and right now we're trading $45 a barrel. Okay, so my target is to get back to whatever I think the perception of value is. But it needs to be pre-identified, and realize that every opportunity is subjective. So you're assuming a target. There's no guaranteed targets out there. There are likely targets, but there are no guaranteed targets. So recognize that is subjective. And it needs to be predefined. As I'm not a fundamental or technical trader, I'm a behavioral trader. As a behavioral trader, I use profiling tools. Profiling tools actually do give me more objective targets, which is why that's the approach that we use. And when we look at how to trade some of these products in the other modules, we'll show you how to do that. What am I willing to risk? One, no opportunity is a 100% layup. So I have to recognize that, I could lose. And in fact, it's better to come into a position believing that you'll lose on the trade than to believe that you'll win. You're getting in and you're playing defense in this position. Okay, what's the ratio of risk to reward that's appealing? Knowing that risk, contrary to opportunity, risk is objective. So every time I'm going to identify the risk, as I'm going off for an opportunity, if I say, I think Apple's got $10 move in it. All right. Well, how much heat am I willing to take on to get that $10? I'm only willing to risk $1 move against me. Okay, that's an objective, defined spot. So if it moves $1 the way it shouldn't move, then I need to take action. Third question: how will I know that I'm right? So when I put on a trade, what we're really doing is we are putting on a hypothesis. And that's, hypothesis is your best guess given everything that's going on, but you're assuming that something is going to happen in the future. And you don't know, I don't know what that's going to be. Now, because of the 4 behaviors and because of what I can see looking through profiling tools, I can have a better understanding of what's likely to occur. But again, it's not 100%, but I'm building a hypothesis on what's likely to occur and happen. And that can include how soon should a opportunity be realized. What's the behavior that should happen? How should price behave? Am I expecting price to behave? Those are things that tell me whether I'm right or not. Another thing that tells me I'm right is if once I'm in the trade, if I can always ask myself, well, if I had no position, would I still like it? If you get in a position and then if you could do the mental homework to go, well, if I didn't have this position, I wouldn't be in it, then that's an idea to tell you that you're not right and that you likely need to take the position off and reassess. And then you'll know what will you do when you're in profit. So if you're right, you're going to know, all right, here's when I'm going to start protecting this trade, or I'm going to start trailing it and locking in gains, or I'm going to or I'm just going to take the trade off and take the profit home. These are all the things that you'll know when you're right. How will you know that you're wrong? So similar, what should not happen after you enter? So this is similar to what knowing that you're right. Well, if I believe that the trade should come good in 5 minutes and we're 10 minutes into the trade and it's not happening, that's probably an indicator that I'm not in the right trade. Or if I expected price to move in a direction or price to just trade sideways and it doesn't do that, it does the alternate to that, that's another signal to that I'm wrong. And I need to pre-identify those so that I know what those look like. And this is key. And you're not going to find a lot of people talk about this when they put on trades, because the world is full of people who say, well, if you follow this system or you put this thing on there, then you're gonna make money. What they fail to tell you is that your brain is wired to stay committed to a bad decision. So there's something called confirmation bias. And the idea is that once you put on the trade, and after you've done your practice and you're doing real money, you'll put on a trade and then the trade will not go as you intended, and you will start convincing yourself why it's still a valid trade. This is really amplified if you put on the trade kind of at the spur of the moment. So by having an answer to these 4 questions before you put on the trade, you're slowing yourself down, and you're also conditioning the brain to think more logically and less emotionally. So you're staying in the frontal cortex of your brain and not in the amygdala, which is the emotion-centered part of the brain, which, if the position goes against you, you'll go into a fight response and you'll just try to fight against it. Sometimes traders will actually double their positions in a losing trade and cause devastation to their account. You don't want to be that person. Okay. So as we have answered those 4 questions, we're going to execute using some common order types. So I'm going to talk about a couple of different order types that are available on most platforms. There are some advanced order types beyond this, but these are some that you need to know. When I started trading, I had no idea what this meant. One is a market order. So this it could be to buy or sell, but this will enter you into the trade immediately. And if you recall in module 2, we talked about the bid and the ask. If I have a market buy order, that's going to get me in right at the lowest ask. If I have a market sell, that's going to get me right at the highest bid. Okay. A limit. So this is a priced order. This is saying only fill me at this price. That could be a buy or a sell. And then a stop. So a stop is a order that we use if price comes back in a direction. So I can put a buy stop above the market, which basically means only get me long or only buy this if I get up to a certain price, or only sell me if I get down to a certain price. And you would say, well, why would you want to buy above the price that's at currently? Or why would you want to sell below the price that it is currently? And the reason for that is that when I am answering these 4 questions, one of the things that I'm looking for is, are there additional participants that are going to go with me? And let's look at an example here real quick. Okay, so here we have a market that is moving lower, right? And then I have a move higher. This is you know, we're assuming a price continuation pullback. Okay, so here's a pullback, and I'm looking for a place to get into this. Now, there's a couple different ways that I can get into this. I could put a market sell order to get short Apple here, or I could put a sell stop right here that basically says if I come back to this level and break it, I want to be short. Which what that it's making it do is making the market, you know, tell me that it's continuing in a downward direction. Make sense? So I can enter this using a limit order. I could, you know, price a limit order. I could use a market order to sell and immediately get in, or I could price it on a sell stop. Then once I'm in the trade, you know, once I would be, you know, say I got in here, okay, and this was the last pullback. Now the market's moving in this direction. I'm going to put a buy stop. So if I initiated a position by selling it, the way to get out of it is to buy it back. So I could have a buy stop here, and if something happened and the price came back through this, it would take me out at this level. So it's a way to protect your position. Stops can be very effective that way. And you'll find, as you know, as you get into having specific brokerage accounts, and there are other order that are available, and some are really fun and offer lots of different complexity to them. But these are the three you got to know. You got to know how to use these as you're entering the trade based off of the answers to the 4 questions. Now, these are not specifically types of orders, but they're times of orders. So a GTD order is one that is only active for the current session. And then you have a GTC order, which is active until canceled. So if I go back over here and look at the chart, all right, this is a session. From here to here is one session. If I put a GTD order, good for the day, that's only going to be active from here to here. If I put on a GTC, that's a good till canceled. That will be, say I establish it right here. It will be active until I cancel it. Now, you know, some brokers will say, you know, like 30 days or something like that, that they'll actually cancel those, but it's more than one session. Okay, so that can be effective, especially if you can't be in front of markets all the time, but you're like, hey, if I get to this price, I want to be active. You can put in a GTC order, and you know, if the market gets that, it'll get you filled, even when you're not in front of it, which can be good and can be bad. All right, so let's go back to our homework here. One, we're going to pick a stock or future to trade. And the reason I say that is because these are the ones that move easiest on sessions and price. And we're going to talk about these when we get to the later modules about looking at those specific products. But you're going to assume a starting balance of $50,000. We're going to have a max trade and account drawdown. What is this? So in the industry, we have something called proprietary trading desks. These are places where if you don't have a lot of capital, you can actually go and try out and be funded. And you have a capital partner who's providing the capital for you to trade, and you're just providing the talent. Okay, all of these companies have what they call a max drawdown. Basically, it's what's the max amount of money that will let you lose out of that starting account balance. So, you know, $50,000, it could be $2,500 bucks. That's the most. If you lose $2,500, you're done. Period. End of story. Now, that's the max account drawdown. Now, for the day or a session, they may have a different parameter, which would be a daily or max trade drawdown. And that may be, if the total account drawdown is $2,500, it may be $1,000 a day. Okay, well, if you hit $1,000 and then you hit $1,000 and then you hit $500 in 3 successive days, you're done. But what we're going to start by creating your own trade and account drawdown. And so here's how we're going to do that. So let's look at Apple here real quick. So Apple, I'm going to go back here to a daily chart. Okay, so let's see. Apple was trading on the 25th of October at 156.32. Okay, so I can actually go in here into investing.com, and I can go to holdings, and I can say I have Apple, and I bought it on 10/25, and I bought 100 shares, Okay, so first question is, can I buy 100 shares? All right, so 169 times 100. Yep, I've got enough capital to buy that. And what was the price that I bought it at? So we said 1025. So let's say 157.90. Let's say we bought it at 157.90. And it cost us $4 to get in the trade. I'm going to add the position. Okay, so you can see right now, this is going to let me have this is the net P&L since that date. All right, let's add a future position in here. So let's use, we'll use crude oil. And let's look at a crude oil chart here. All right, and let's say that we bought crude. We saw that it was balancing sideways. You know, so we saw multiple day sessions. We were in rest, and then here's the next move. So we got in at about 58.60. Okay, and we bought one contract. So we're going to say one at 58.60 on the 26th. And we paid $250 for that one. All right, so a couple things. One, notice the market value of this position. Now, what investing.com doesn't show you is how much capital it costs to put the trade on. And we'll talk about this. Crude oil uses, you know, we talked about in module 1, we talked about crude oil it's a future, uses margin. And so there's a margin requirement. It's actually about $2,300 to put on this position. But what you're controlling $60,000 worth of product. Where Apple, it's just the share value. But it's good to have the two different positions to kind of see how these operate and see how these work. So here's the crude oil, here's Apple, and you can say, okay, you know, what's the target? When am I wrong? Stuff like that, and you can play with it like that. So that's your homework, is to, you know, grab some products and try trading them, placing trades, having answered the 4 questions, and remembering the 4 behaviors. Review this video, complete the homework, proceed to the next module. As always, if you get hang up or you have additional questions or need some more clarity, shoot me an email, give me a call, or if you're in the group Build a Profile, hit us up in Slack, and we'll keep you moving forward. All right, y'all, that's module 3 out of 12. We're making progress, and hopefully you're enjoying this along the way. Talk to you for the next module pretty soon.